Welcome to Loup Weekly. Yes, Loup Weekly. This is a recap of what was most important in tech land over the previous week. And today we're looking at the week that ended on Friday, March 25th. I'm Gene along with Doug. Our four topics today include Google and Spotify treading new ground related to App Store take rates. Second is related to Apple and what they're doing about diversification in China. We're also going to talk about late-stage valuations, including a revaluation on Instacart, and end in the toy, aka crypto department, and talk about unique ways that people are mining crypto along with the currency just becoming more embedded in the global movement of value. And so we'll go back to the top. For those of you who are new to Doug and I, we've worked together for a long time. We have an outstanding working relationship. We do not agree on everything. There are two topics that we're most notably in a disagreement on. One is related to Tesla and the EV space more broadly. And second is related to Apple and its ability to maintain its take rates. In the past, Doug has been very clear, take rates need to come down by a lot. And they are, as a point of reference, typically 15% on both Google and iOS for subscriptions and 30% for in-app purchases. If you are a smaller developer on iOS, below $1 million in gross revenue, you pay just 15%. But our previous conversations have been Doug putting a flag down and saying the take rates need to come down a lot, and Gene saying, agree, take rates need to come down, but eventually it's not going from 30 to 10, it's going from 30 to 25 to maybe 20. So we agree in principle, but disagree in terms of the speed and that slope. And so score one, Doug, for you on this news. You want to bring it up to speed on what was announced this week?
The announcement was Spotify is working with Google. They're doing a pilot on Google's Play Store where Spotify will be able to add its own payment mechanism. So historically, on both the App Store and on Google's App Store, developers had to use the native payment mechanism. So on the App Store, you have to use Apple's. On Google's Play Store, you have to use Google's payment gateway. And sort of what's been at issue here, I think, with this whole app dispute and starting with
let me interrupt before. You've been saying all along is function of time before more wallets are added to these app stores. So keep rolling. You said what's at issue here is?
Just with the Epic trial, I think what Epic was really pushing for at its essence was to say, we think that we should be able to use our own payment mechanism. And Epic's view was that should result in lower fees to them. It gives the consumer choice, which I think is true. And then the consumer can say, I want to pay through the native mechanism, which may be Epic or Spotify in this new example, or I'm happy to pay through Apple's mechanism or Google's mechanism. And so what we're seeing here for the first time, and I think is noteworthy, is that we will have competitive payment mechanisms on this pilot in Google Store. They did say that they're also going to work with other developers for this pilot. And we'll see. I think you're going to get a lot of data in terms of how consumers think about these different payment mechanisms. I could see a scenario where these developers maybe try different price points, where they take the savings that they may get by going through their payment gateway and try to give it back to the consumer. But it's really early, and I think I still feel good about
hold on, Doug. Hold
on
the
these take rates need to come down.
Yeah, hold on the where it's going. That's the most important part of this, but I want to make sure we're framed in on what's going on. So the specifics around the take rate is that there are not specifics. This is a program. They do mention a framework in South Korea. That South Korea framework is it reads that there is an 11% take rate on subscriptions. And so, as I mentioned, right now, Google and iOS, Apple have a 15%, so that's a 4% decline, and also a 4% decline on their in-app purchases, whether it's 25 going to 21 or 30 going to 26. And so we've seen this decline. And so I just want to kind of put it in a perspective is that is a monumental move to have a new payment mechanism put in place. I would say that it is a measurable move down on the take rate. Going from 15 to 11 is a big deal. Mathematically, that's a big number. 30 to 26 is less of a shift, but it still is meaningful. And so I want to, before we kind of go long term, or yeah, let's go to your view. Like that's where we're at today. Is this pilot's going to go on? The pilot starts kind of late this year, and let's kind of fast forward now, 2023, 2024. Where do you see the take rates ultimately going?
I still think that take rates across the board go toward 10%. And so specifically, we think about the breakdowns between these take rates. What I think changes most is developers who are doing in-app non-subscription commerce above that $1 million mark. I mean, those are really the developers we're talking about, and that's the Epics of the world. You know, a lot of them are game publishers. And so the Match.coms and the Spotifys who have been pushing back, maybe they say 4% is enough, maybe they get a little more. Just to be clear on this South Korean thing, what Google said is they will build on the policy introduced in South Korea, which, to your point, is a 4% reduction of whatever the base fee is. That's the South Korean policy. Build on, to me, says that that policy is being negotiated with Spotify. So maybe it goes down a little more, maybe they do some other things with it. We'll see. But my bottom line is, I think that's the ultimate end game here, is that this distinction between subscription and non-subscription, this distinction between $1 million below and $1 million above, I think over time that goes away. And I think everybody kind of ends up in this 10% range over time. Got it.
So don't focus too much on the details. Look at the substance here. That's a breakthrough in terms of allowing a wallet. There's going to be a lot of data that's captured over the next year. It's not going to even get going until the end of next year. If you're curious right now and you want to get on Spotify and get a premium membership, whether it's on Android or on iOS, you have to go around. You basically have to visit directly the website, very similar to how Netflix does their subscriptions. And so I hear you there. And just to finish the thought out, where I would end up at, you're talking about everything kind of gravitating to 10. I still think there's going to be two different scales of the payment mechanisms. And I think that 20 to 25% range, I'm specifically about iOS because I think that their conversion is, they have a better conversion mechanism to be debated. They're 10 to 25%. Doug's saying it's going to gravitate to around 10%. And I'm saying on the other subscriptions, I generally agree that probably 10% on the subscription. So as far as timing, I think we're probably a few years away, and I'll give you a final word on timing.
Probably a few years is right. And I think the other wild card to the whole thing, and this comes to your timing discussion too, is what the outcome of the steering verdict from the Epic trial will ultimately be. I think steering adds another layer to this, right? Because let's say Spotify now has two options with Google. They can say, we want to let you pay with our gateway. We want to let you pay with Google's gateway. And oh, by the way, if you go to Spotify.com on your browser, you can get 10% off or 30% off or whatever it is. And so I do think that the steering conversation does matter here. And that's something that, again, that 2-year-ish window we're talking about in terms of getting more data, getting more resolution. I think that element of the trial from Epic will probably be resolved by then. And if steering is something that we end up with, then I think that it makes that 10% case even stronger.
Nice. We're going to stay on the Apple topic. Question for you, Doug. Before March of 2022, were you familiar with the concept of strategic ambiguity?
No, I don't think I was.
I was in that same camp, was not aware of it. This, of course, is the policy that mainland China has related to Taiwan. It allows Taiwan to essentially have its own free elections, to operate a military, and to use capitalism, and basically operate as a separate company, separate country. However, they cannot acknowledge or cannot speak of themselves, and no one really can speak of Taiwan as a separate country. And so there you have it. That is strategic ambiguity. It's important for the Apple topic and where they are going with the supply chain longer term. And typically when we talk about Apple and the supply chain, we're talking about what has gone on with the some of the impacts of the pandemic and a slowdown. But what essentially the Russian invasion of Ukraine has done is highlighted something that's been there all along, but just hasn't been as top of mind, at least for me, is the relationship between China and Taiwan. I mentioned the strategic ambiguity piece of Taiwan and how they're governed, but separately, just some quick context. There's about 24 million people. It sits about 100 miles off of the coast of China. It as an island, a country has traded hands like baseball cards over the last 500 years, and in the 20th century ended up under China control. And then over the last 40 years, there has been this strategic ambiguity opportunity. During that time, Taiwan has flourished. And of course, the biggest headline is they produce about 90% of the globe's advanced semiconductors. That's used in everything from like the iPhone, the M chip, the A chip on the iPhone, the M and the Max, all the major chips that impacts cars, all the way through defense systems. And that is all good and well if strategic ambiguity is going to remain. But in October, the president of China, Xi, made it very clear, I'm not going to quote him, but very clear that that his patience around strategic ambiguity is wearing thin, and that that it is a function of time before this comes back. And I'm doing all the talking here because it's related to a piece that I wrote, but just to quickly finish the thought is when you start to play that forward, you can see some real massive is the right word, disruptions in the supply chain if and when that control governance is shifted back to the mainland of Taiwan. And I mention it because Apple has exposure there. They have risk. We've went and looked at the major tech companies, and Apple is close to the top. You can debate whether it's the most at risk. They have 18% of their sales come from China. That business in 2021 was the exact same size as the business of their services business, $68 billion. They have, I estimate that 85% of their products are made in China. And so there's an aspect on the production side, very hard to move that production to other places. But Apple has been working over the past 5 years. I didn't realize this. They've been working over the past 5 years to try to move that. Now they do more assembly. Some Macs are in Malaysia. There are AirPods in Thailand. Vietnam is another area where they're doing, I believe, Apple Watch. And so they're starting to move some of that. They do some Macs are assembled in the US, starting to slowly move that needle. And I just would finish with this thought is that in 2018, so this is 4 years ago, Apple said that they're going to invest, at the time it was like $350 billion into investment in the US. That it was with a B. I mean, these are huge numbers. And now in the spring of 2021, they announced that that would move up by 20% to $430 billion. And then it begs the question, that's for just US investment. What can you do with $430 billion? And the answer is, if you look at some of the rumors around how much Intel is going to be spending at building its fab in Ohio, that's projected to cost about $20 billion. If you're also want a point of perspective, is that a new stadium, a football stadium, costs between $1 and $2 billion, something in that range. So fabs are expensive to build. They take about 3 years to build, but Apple could do 20 of those in the U.S. And the point is this, is there's going to be a lot of hand-wringing on this topic related to China, Taiwan, global supply chain for a lot of companies. Apple is going to be right there, forefront center of that anxiety. And I can see some ebbs and flows in how investors think about this, but would just come back to they've seen this coming. They're making investments, and you can debate whether they can move fast enough. But that was the topic. Check out the piece. All the numbers are in it. We published it today. Doug, I'm not going to even give you a thought on that just because I spoke
I'm going to take one,
too.
though.
Oh, go for
not
it.
on Apple, but I think just we think about this idea of strategic ambiguity. To me, there's no ambiguity about how strategic Taiwan is from a semiconductor manufacturing perspective. And so even setting Apple aside, I think it's imperative that we figure something out. You mentioned Intel, and Intel's CEO, this is, I guess, a bonus news item. Pat Gelsinger was in Washington this week, kind of talking to Congress about the importance of getting semi-manufacturing back to America. And I thought there was a couple stats that were just interesting to think about. In the 90s, between Europe and the US, we produced about 80% of all semiconductors. And today we produce about 20% of all semiconductors, and the
Mhm.
vast majority are produced in Asia. Taiwan produces 90% of all advanced semiconductors. So the chips that operate your iPhone, the chips that operate your Apple Watch, those all come from TSMC in Taiwan. And I think that there is this massive wave that's coming. And I think it's like a tsunami that should be obvious at this point,
Mhm.
right? With the amount that Intel is spending. But there's this massive wave coming of trying to figure out how do we get chip manufacturing back into Europe and back into the United States. And I think that's something we're going to be talking about for a very long time.
Agree. Something that we have been talking about for the past few months is this disconnect between late stage private valuations and public valuations. I think the average SPAC was down 40%, 40 from its highs, many of them down 80, 90%. And you have these valuations as we kind of continue to traffic in late stage market, these valuations that haven't come down until this week.
That's right. This week is really, I think, the first time we've seen this, but Instacart reduced its private valuation from 40 billion to 24 billion. So that's a 40% reduction. And if you put that into perspective, compare it to DoorDash, which is probably the fairest public comp that we could look at. From the time that Instacart roughly did its last round, which was the beginning of 2021, it's about a 50% reduction in the value of DoorDash as a public company. So 50% drawdown for DoorDash, 40% drawdown for Instacart, in the same ballpark. And from
Mm-hmm.
DoorDash's highs, DoorDash is down about 60% from November, along with a lot of other high multiple tech. So again, we talk about this kind of wave with chip manufacturing coming back to America. I think there's a similar wave on the private side in terms of just getting these valuations right sized and just reflecting kind of this new valuation paradigm that we're seeing in the public markets as it relates to tech companies.
What's always surprised me is just how again, we have the ability to go both private and public, but how on the venture side, it's just, blissfulness. But there's naturally, you have to at some point for liquidity, they get acquired or make the jump to being a public company. And that jump to public company, you are compared off of the public valuations are going to pair off of public companies. And so
Mhm.
it was always a head scratcher for me why we haven't seen more of an adjustment in some of these late stage valuations. I think it's healthy for the market, both the public and the private market, to see some of these adjustments. I'll give you a final word on the topic.
The private markets are always slower to adjust. And we've seen this throughout history to what's happening in the public markets. You can call it a feature, you can call it a bug. The good thing is that your felt volatility, if that's a term, is lower. You don't see the swings in the market like we've been seeing over the last 3 or 4 months in tech. I think the downside, though, is that sometimes the private markets don't really reflect reality. And for many of these companies, we look at a lot of deals, primary and secondary, and we're still seeing valuations that seem to reflect very bright futures for these companies that price in a lot of future demand for performance. And so we've always said internally, price is really just a future demand on business performance, because you have to take whatever cash flow a business generates and discount it back to the present to justify the price. And when I talked about that valuation paradigm kind of changing in the public markets, I think we're kind of returning to fundamentals in finance and the reality that our companies do need to generate cash. And for these companies that are valued in the tens of billions and some even near the hundreds of billions of dollars, they have to generate a lot of future cash flow to justify their price. And so we're seeing the market say, hey, like the odds of you generating the cash you need to generate are maybe lower than we gave you credit for 2 years ago when interest rates were super low. And I think that that paradigm is going to continue for a little bit. And we're going to see more of these sort of markdowns in the private market as a result.
Makes sense. I promised we'd end in the toy department, the crypto department, and here we are. And the phrase of the day is digital flare mitigation systems. Digital flare mitigation systems. Why is that the lead in the toy department?
Because Exxon is using digital flare mitigation systems to do something that's pretty unique, I think, which is capture gas that comes off of oil rigs and
That
use that
burning that
gas.
the waste.
Essentially the gas is waste, that's right, and they're burning it, capturing it, burning it to create energy to mine Bitcoin. And so, thought of in a much simpler context, they basically figured out how to take the exhaust from the operations of an oil rig and turn it into a profit center instead of a cost center, making digital currency.
Why not? My question is, if you can do that, this digital or this thank you, digital flare mitigation system. If you can do that, why does it necessarily have to power crypto? Why not just go and charge up batteries? And maybe because it's so far out of nowhere, it'd be too expensive, or you'd like degrade the energy as it gets transported.
You could probably get into some pretty geeky corporate finance calculation in terms of what is the value of using the electricity to mine Bitcoin versus do what you said, which is maybe store it and try to put it on grid, and what the cost of that might be versus the profit you'd make on it. I did see that the company that is powering this technology, pulling up the name, Crusoe Energy Systems, they do say that their technology can be used in addition to mining Bitcoin to power things like AI applications. So they could power, kind of to your point, maybe a data center or a computer that's running complex calculation instead of something that's on grid.
And lastly, in terms of crypto, the use of crypto, even though it is for shameful purposes, is continuing to get adoption related to Russian and some of their energy.
And that's, we can talk about the shameful piece. That's part of the feature or bug, depending on what side you land on with it. Part of the set of sort of Bitcoin, I think, advantages is it is not censorable. And so there was a report out that Russia is exploring, it doesn't sound like it's confirmed that they're doing this, but exploring the ability to accept Bitcoin as a payment for oil and gas exports. I think it makes sense for them, right? In the context of the situation with sanctions, they're going to look to these technologies that are purposefully not censorable, and perhaps use them for nefarious means. We've known that nefarious usage of Bitcoin is a little bit part of what happens when you create an open and free platform, which is the real underpinning of the currency. So we don't really need to debate whether it's right or wrong, but I think it is a clear use case for certain users to say, look, if someone in the world says they don't like me doing a certain thing and I think I should be able to do it, I might look to crypto to do it.
We're going to wrap there. We also made headway here with the first Loup Weekly. We're also going to make headway what I'm going to say next. And I'm inspired by one of Loup's trusted advisor who says, ask and you shall receive. So please like and subscribe. On that note, on behalf of Gene, Doug, and Loup Weekly, bye for now.